You are earning a high US salary. You are saving a significant portion of it. But if you are like most H-1B professionals I talk to, you are likely losing out on your absolute best wealth-building years, simply leaving your money in cash because of visa anxiety. The issue here is not a lack of capital. The issue is misallocation. We bring cultural biases with us to the US, specifically a strong preference for the perceived safety of liquid cash and Indian fixed deposits. This chart shows exactly what that bias costs you. If you take $10,000 and park it for 20 years, a standard US savings account at 4% grows to about $21,000. An Indian FD at 7% reaches $38,000. But that same $10,000 invested in the S&P 500, which has averaged a 10% annual return over the last century, grows to nearly $67,000. And the reality of that Indian FD is actually much worse. You pay tax on that interest every single year. Plus, when you account for the Indian rupee depreciating against the US dollar, your real usable return drops significantly. The US savings account isn't safe either. With average inflation running around 3%, keeping large amounts of cash at 4% means your purchasing power is actively bleeding out year after year. By prioritizing the short-term illusion of safety, you are mathematically guaranteeing a long-term financial loss. The biggest reason immigrants hesitate to enter the US market is a persistent myth, the idea that you need to be a US citizen or a green card holder to participate. Let's clear that up right now. If you hold an H-1B, an L-1, or almost any other valid working visa, you have the complete legal right to open US brokerage accounts and invest in the exact same assets as any US citizen. But then comes the paralyzing question: what if my visa isn't renewed? What if I am forced to pack up and move back to India in 60 days? The answer to that is what we call the borderless portfolio. It is a strictly legal, fully compliant, low-effort investment system designed specifically to insulate your money from the uncertainty of your immigration status. Your physical location does not dictate the survival of your wealth. Your U.S. brokerage accounts remain entirely valid, legal, and manageable from anywhere on the planet. Before you buy a single stock, you need to put your money in the right buckets. Choosing the right account is more important than the specific investment you buy. Looking at this order of operations flowchart, your absolute first priority is your employer-sponsored 401k, up to the employer match. This is pre-tax investing, meaning it immediately lowers your U.S. taxable income, and the employer match is quite literally free money. The clear trade-off here is liquidity. Money in a 401k is locked away for your retirement. Withdrawing it before age 59.5 triggers severe tax penalties, so you only contribute funds you do not need in the near term. Once you get your full employer match, your second priority is a Roth IRA, which you can open at places like Fidelity or Schwab. You fund a Roth IRA with post-tax dollars, meaning you pay taxes on it at your current income bracket. It is also restricted to a $7,000 annual contribution limit. But in exchange for those limits, every single dollar of future growth and all your future withdrawals are completely tax-free. Finally, once your tax-advantaged accounts are maxed out, you open a standard taxable brokerage account. There are 0 contribution limits and 0 withdrawal penalties here, giving you total flexibility, though you will pay standard taxes on your gains. Remember, these accounts are just tax shields. They don't make you money on their own. The wealth generation comes strictly from the assets you choose to place inside them. When it comes to picking those assets, the urge is always to find the next big tech stock. But the greatest investor in history, Warren Buffett, explicitly recommends passive index funds for regular investors. The data backs him up. Over a 10-year period, 90% of professional Wall Street fund managers fail to beat the returns of the S&P 500 index. If highly paid professionals with inside data can't pick winning stocks consistently, you shouldn't try to either. This matrix compares the optimal passive approach, known as the 3-fund portfolio, consisting of total U.S., total international, and U.S. bond market funds, against the typical immigrant approach of active stock trading. By utilizing the 3-fund strategy, you guarantee that you will capture the total return of the global market. It requires almost 0 time to manage, carries incredibly low expense ratios, and keeps your tax situation simple. The main trade-off? It is incredibly boring. You do not get the dopamine rush of overnight gains. You just get quiet compounding math. Now, compare that to a common trap: immigrants trying to day trade individual Indian stocks through Indian brokerages while living and working in the US. Doing this immediately subjects your returns to the depreciation of the rupee. Worse, it triggers massive and highly complex F-bar reporting requirements with the IRS. The superior approach is dollar cost averaging. You set up your US brokerage account to automatically buy your index funds on the exact same day you get your paycheck, every single month, ignoring the news entirely. For a high-earning immigrant, financial success means trading the thrill of trying to beat the market for the mathematical certainty of low-cost indexing. Of course, investing in the market means facing market crashes. Let's be clear, massive drops in portfolio value are a guaranteed feature of the system, not a bug. They will happen. Panic selling during those drops is the single worst financial mistake you can make. If you sell, you lock in the loss permanently. The S&P 500 recovered from the 2008 financial crisis in 4 years. It recovered from the 2020 crash in just 6 months. Time in the market heals all crashes. Time also handles your taxes. If you buy and sell a stock within a year, the IRS taxes those short-term capital gains as ordinary income, potentially up to 37%. Hold that exact same asset for more than a year, and your long-term capital gains tax drops dramatically, usually to just 15%. This decision tree maps out exactly what happens if your H-1B visa expires and you have to leave the United States. You have 2 choices. First, you could liquidate. Selling everything upon your exit triggers immediate, unnecessary tax events and risks cashing out during a market low. Second, you can simply leave the accounts open. You can manage your U.S. brokerage completely remotely from India. Your assets continue compounding in U.S. dollars, completely uninterrupted by your flight home. When you do eventually sell assets while living in India, the Double Taxation Avoidance Agreement, the DTAA, provides a legal framework to ensure you get credit for taxes paid in the U.S., preventing you from being fully taxed by both governments on the same money. Visa expiration is a logistical change. It only becomes a financial crisis if you panic and liquidate, rather than relying on tax treaties and remote management. The rule here is absolute. Time in the market beats timing the market, and U.S. index funds are the most efficient wealth vehicle available to you as an immigrant. If you are an overcautious saver sitting on a pile of cash, recognize that inflation is actively eroding your hard work. You must deploy it. If you are paralyzed by visa anxiety, recognize that your accounts survive even if your H-1B doesn't. Stop letting uncertainty delay your financial independence. Here is your exact 3-step action plan. Step 1. Open a brokerage account at Fidelity or Schwab and transfer your first $100. Step 2. Buy fractional shares of a U.S. index fund like VTI. Step 3. Automate the transfer every month. Market crashes are temporary, but lifestyle inflation and the years you lose by waiting to invest are permanent losses. Building generational wealth in the U.S. starts with a single automated transfer. See you next week.